There are moments in financial history when a single number forces people to stop and think, not because it sounds realistic, but because the math behind it refuses to go away. Over the past few weeks, one idea has been circulating through the precious metals community. The idea that silver is not just undervalued, but structurally mispriced relative to the scale of global debt. And before you roll your eyes and dismiss that as another silver to the moon prediction, I want to slow this down. Because this is not about hype. It's about ratios, it's about history, and it's about how debt systems eventually rebalance. Let's begin with something most investors never look at. Not silver, not even gold, debt. Specifically, US government debt compared to hard monetary assets. Go back to the 1940s. During World War II, the United States accumulated massive debt to finance the war effort. But there was something fundamentally different about that debt compared to today. A significant portion of it was implicitly anchored to gold reserves. The dollar was tied to gold. The system had discipline. There was a limit to how far expansion could go before the currency itself had to reprice. Now, fast forward to today, debt has exploded to levels never seen in peacetime history. But gold reserves haven't grown meaningfully. The vault didn't expand, the liabilities did. That creates a widening gap between what is owed and what exists as hard backing. And historically, gaps like that don't stay open forever. They close in one of two ways. Debt collapses, or the asset reprices. There is no third option. This is where the conversation gets interesting. Because when you look at history, gold has repeatedly repriced during periods of excessive debt stress. The 1930s, the 1970s. Both were eras where confidence in currency wavered. Both were eras where gold surged dramatically. Not because gold changed, but because the value of currency did. Now here's the part most people miss. Gold doesn't need to return to a full gold standard to reprice. It only needs a credibility event, a moment where markets begin to question whether debt growth is sustainable. And we're closer to that moment than most realize. Let's talk about another ratio that compresses 100 years of financial psychology into one line. The Dow divided by gold. This ratio tells you whether stocks are expensive relative to hard money. When it's high, investors prefer equities. When it's low, investors prefer protection. In 1929, the ratio peaked. In 1933, it collapsed. In 1966, it peaked again. In 1980, it collapsed again. In 1999, it reached an extreme level. And since then, it has been trending downward in waves. Here's what matters. Every time this ratio begins a sustained decline, gold outperforms equities dramatically. Not slightly, dramatically. Now think about where we are today. Debt is at record highs. Real interest rates are unstable. Geopolitical tensions are rising. Inflation hasn't fully disappeared. And equity valuations remain historically elevated. That's not a stable long-term equilibrium. That's tension. And tension resolves. The question isn't whether gold will reprice. The question is how much. But we're not here just to talk about gold. We're here to talk about silver. Because silver historically doesn't just follow gold. It amplifies gold. Every major precious metals bull market has shown the same pattern. Gold moves first. Silver lags. Then silver accelerates faster. It's volatile. It overshoots. It compresses the gold to silver ratio dramatically during peak momentum. And this ratio is critical. Right now, gold buys dozens of ounces of silver. But historically, during peak metal cycles, that ratio tightens significantly. In the 1970s, it compressed aggressively. In 2011, it tightened sharply again, each time silver outperformed gold in the late stage of the move. Now let's address the elephant in the room. Silver is not officially a monetary metal today. Central banks buy gold. They don't buy silver in meaningful quantities. So why would silver outperform? Because silver has something gold doesn't. Industrial dependency, solar panels, electronics defense systems, medical applications, high-tech manufacturing. Silver is not just a store of value. It's a critical input into modern infrastructure. That creates a dual demand structure. Monetary demand when confidence drops. Industrial demand regardless of monetary policy. And here's where it gets even more important. Silver supply is not infinitely elastic. Opening a new mine takes years. Expanding production takes years. Permitting a loan can take a decade. So when demand accelerates, supply doesn't instantly respond. That delay creates price spikes. We've seen it before, and we could see it again. Now let's talk about the bearish argument, the smart one, the one that deserves respect. The argument says, if silver rises, miners will produce more. Increased supply will cap the price. On paper, that makes sense, but history complicates that theory. During the 1970s, prices exploded despite increased mining activity. Why? Because macro forces overwhelmed micro adjustments. When currency confidence shifts, investment demand can dwarf production increases. And we are in a macro environment that resembles historical stress periods more than stability periods. That doesn't guarantee explosive upside, but it increases the probability of structural repricing. Another risk worth mentioning, liquidity events. In 2008, everything sold off initially, including gold and silver. In a panic, investors sell what they can. Silver is volatile. It can drop sharply in the short term, even within a long-term bull structure. So this is not a straight line up thesis, it's a cycle thesis. Cycles take years. They test conviction. They shake out weak hands. But when they complete, they often overshoot expectations. Now zoom out. If debt continues expanding faster than economic output, if inflation remains structurally sticky, if geopolitical fragmentation increases, if central banks lose even partial credibility, then hard assets reprice, not because of hype, but because math demands equilibrium. And silver, due to its smaller market size, historically moves more aggressively during those adjustments. Let's put this in perspective. Silver today is nowhere near inflation-adjusted highs. It's nowhere near previous mania levels. It's not being chased by retail in a frenzy. It's climbing methodically, quietly under the surface. That's how early phases look. Late phases look different. Late phases look like headlines. They look like disbelief turning into urgency. They look like price acceleration. We're not there yet, but we may not be as far away as people think. Here's what I believe. Gold likely reprices first. Silver follows. Then silver accelerates. The magnitude depends on how aggressively debt imbalances resolve. If go. Vermints maintain control and engineer a soft landing, upside is moderate. If credibility fractures, upside expands dramatically. This is not about predicting an exact number. It's about understanding positioning within a multi-year structural shift. The 1970s cycle took nearly a decade to complete. The 1930s revaluation wasn't instant. These are slow burns that eventually ignite. And right now, multiple long-term ratios are flashing signals that we are inside one of those historical windows. Does that mean silver goes vertical tomorrow? No. Does it mean volatility increases? Almost certainly. Does it mean the next 5 to 7 years could look very different from the last 10? That's the real question. Not can silver move, but how far could it realistically go, and what would need to happen for each level? Because throwing out massive price targets without showing the pathway is just noise. So let's build this step by step. No hype, no fantasy, just layered scenarios. Step 1. The gold anchor silver does not move in isolation. It amplifies gold. So before we talk about triple-digit or four-digit silver, we have to talk about gold's trajectory. Let's define 3 possible gold outcomes over the next 5 to 8 years. Scenario A, controlled debt. Environment. In this scenario, governments manage to slow deficit expansion. Inflation cools, but doesn't disappear. Central banks maintain credibility. Gold benefits from structural demand, but doesn't enter panic mode. In that case, gold reaching $8,000 to $10,000 over several years is plausible. That alone would be a major repricing from current levels, but not a currency crisis, just structural debt adjustment. Scenario B, persistent inflation and financial stress. Here, inflation proves sticky. Bond markets begin demanding higher yields. Debt servicing costs spiral. Governments quietly tolerate inflation to reduce real debt burdens. This is similar to the 1970s pattern. Under this structure, gold between $15,000 and $20,000 becomes mathematically defensible. Not overnight, over years. Through volatility, through corrections, but in a stair-step repricing cycle. Scenario C, confidence. Event this is the extreme. A sovereign debt scare, a currency confidence break. A major bond market failure. If credibility fractures sharply, gold overshoots dramatically. That's where numbers above $25,000 enter the conversation. Not as base case, as crisis overshoot. History shows that when confidence collapses, hard assets don't move rationally, they move violently. Now let's layer silver on top of each scenario, because this is where it gets powerful. The gold to silver ratio. Compression silver outperforms when the gold to silver ratio compresses. Historically, during stress cycles, the ratio contracts. During calm cycles, it expands. Right now, the ratio remains historically elevated compared to peak bull phases. In major bull markets, 1970s, ratio compressed dramatically. 2011, ratio tightened sharply. Late cycle metal rallies, silver accelerates. The key insight: silver doesn't need the ratio to hit historical extremes to generate massive returns. It just needs partial compression. So let's run the math. Scenario modeling case. 1. Conservative path gold. 10,000 ratio, 40 silver powers. 250. Now pause. 250 Da. Silver is nearly 3 ricks from current levels. That's without panic, without extreme compression, without a currency crisis. That's just steady repricing and modest ratio tightening. Already powerful. Case 2, moderate bull cycle gold, 15,000 ratio, 30 silver. GONGS 500 this aligns with historical non-mania compression levels. No extreme distortion, just a typical precious metals bull phase. $500 silver is roughly 6x from here. That's transformative. And it doesn't require fantasy assumptions. It requires persistence of debt pressure and continued industrial demand growth. Case 3, strong cycle with deeper compression gold, 20,000 ratio, 25 silver. Larger 800, this scenario assumes sustained macro stress and solid investor participation. Still not the 1980 extreme, still not mania territory, just strong multi-year repricing. $800 silver represents nearly a 10x move, and historically, silver has achieved similar multiples during structural debt resets. Case 4, aggressive compression gold, 20,000. Herd ratio, 20 silver, Karg 1,000. Now we enter psychological territory, 4-digit silver. This requires heavy investment demand, strong industrial pull, accelerating momentum, widespread awareness, not impossible, but not base case, still mathematically clean, still grounded in historical precedent. Case 5, crisis. Overshoot gold, 25,000 plus, ratio, 18 or lower silver, scraping $300 to 500. This is the blow-off phase. This is when mainstream media finally notices. This is when volatility spikes. This is when corrections are violent and emotional. And here's something critical. Overshoots never last long. They are peaks. They are exhaustion phases, but they happen. Every time. The timeline. Question now, let's address timing. Because timing destroys more investors than bad math. Major metal cycles historically take 6 to 8 years from early breakout to peak. The 1970s move was not a straight vertical line. It was rally pullback, consolidation, acceleration, blow off, expect volatility, expect 20 out to 30% corrections along the way. Silver is famous for shaking people out before launching higher. If this cycle mirrors history, the strongest acceleration likely comes in the later stages, not the beginning. That means patience matters more than prediction. The supply reality. Now let's revisit supply, because critics argue higher prices solve shortages. In theory, yes, in practice, slowly. Mining timelines, 7 to 10 years to develop new projects, 3 to 5 years to expand operations, permitting delays growing globally. And here's something many miss. Most silver is produced as a byproduct of other metals like copper and zinc. That means silver supply often depends on demand for entirely different commodities. If global growth slows, base metal mining slows, which can restrict silver supply further. So higher silver prices don't instantly unlock massive new production. There's structural friction. And friction in supply during rising demand equals volatility. Upward volatility. Industrial demand acceleration. Silver's industrial use is growing in solar infrastructure, EV systems, electronics, medical technologies, military systems, energy transition policies globally require silver-intensive systems. That creates a baseline demand floor. Unlike gold, which is primarily monetary, silver has dual demand engines. That's powerful during expansion phases. It means silver can rise even without full monetary panic. The bear case. That matters. Let's be honest. There are real risks. Severe global recession causing temporary liquidation at technological substitution, reducing silver intensity, political stabilization, reducing inflation pressure. These could delay or dampen upside. But here's the key. None of these erase the debt overhang, and debt cycles historically resolve through repricing. Not discipline, not austerity. Repricing. The psychological shift, the biggest moves in metals don't start with retail. They start quietly. Then institutions accumulate. Then media attention increases. Then retail chases. Then mania. We're not in mania. We're not even in widespread retail excitement. Search interest is muted. Mainstream coverage is limited. That's early to middle cycle behavior. Late cycle looks different. It feels different. It's loud. We're not there yet. So what's realistic? If I strip out extremes, if I remove crisis, overshoot, if I use moderate compression, silver between $400 and $800 over the next 5-7 years is not a fantasy. It's structurally defensible. It requires continued debt expansion, mild to moderate inflation, ratio normalization, industrial growth, gradual investment participation, nothing supernatural, just historical rhythm repeating. And if confidence fractures, the ceiling expands. But you don't need $3,000 silver to justify long-term positioning. You don't even need $500. Even the conservative pathways represent life-changing multiples. Final perspective. Think about this clearly. Silver at $80 feels normal today. $150 would feel shocking. $300 would feel impossible. $500 would feel insane. But that's exactly how exponential cycles feel in the early stages. In 1973, gold at $180 felt high. By 1980, $850 felt inevitable. Perspectives shift slowly, then all at once. The math we walked through isn't hype. It's ratio compression layered onto debt expansion. And every major debt era in modern history ended with hard assets repricing. The only variable is magnitude, not direction. So the real question isn't, is $1,000 silver possible? The real question is, what does the world look like if debt keeps compounding faster than growth? Because in that world, the numbers we discussed stop sounding extreme and start sounding mechanical. That's the hidden part of this cycle most people haven't processed yet. And by the time they do, the repricing phase may already be well underway.